Good afternoon, everyone, and thanks for joining us for this event, the latest deliverable of the Digital Collective Africa. So today we are going to talk about a common due diligence checklist that has been developed by the Digital Collective Africa. For the ones that are not too familiar with the brand yet, the collective is actually composed of African investors, tech hubs such as incubators and accelerators, as well as founders. And the aim of the collective is to facilitate and to foster the investment into early stage startups in Africa. So the collective works into various kind of projects. The prior deliverable was a term sheet template. The collective is also lobbying for different initiatives such as Startup Act in South Africa. Thanks for joining us. The program of today is going to be quite straightforward. We will have a presentation of the document that will be released publicly at the end of the event by its author, Titilayo, Arasi. And then we will move on to a panel discussion with four esteemed and experienced guests who are going to share with us their experience, their insights, and also answer to any questions you may have. In terms of a timeline, Titi is going to be presenting the document for roughly 8 minutes, and then we move on to the panel discussions. We will have a discussion for roughly 30 minutes, and then we will take 10 minutes to answer, 10 to 15 minutes to answer any questions you may have. So please ask your questions into the chat box. Without further ado, let's welcome Titilayo Arasi. She is working with AfricArena. Titilayo is currently based in the US. She is undertaking an MBA at Tuck School of Business at Dartmouth, and she was previously working at IBM for almost 7 years. Titi, welcome. Can you hear me clearly?
Yes, I can hear you.
Thanks for joining us today. Thanks for the work that you have been doing for the collective. We are going to go through a couple of slides. I'm going to ask you a couple of questions. The idea is just to give a high level detail and idea of the document. This document will be available after this event on the website of the collective. You can see it on the slide now, Digital Collective.Africa. So Titi, can you tell us more about how did you end up working on this project, but also what is the goal of this project? What is the goal of having a common due diligence checklist?
Yeah, sure. So I just have a profound respect for founders. They have a hard and challenging job, and at the end of the day, they just want to fix a problem and make a group of people's lives easier in some form or fashion. So my interest in this project lies in my desire to make their lives easier and help build a resource that will give more transparency to the already daunting fundraising process. So when founders are able to put their best foot forward in early stage fundraising, they end up having a more fruitful relationship with their investor, which will also set them up for future fundraising rounds. So personally, I'm interested in creating ways that can further provide greater access to capital across the board and create a more inclusive network that founders can tap into. So the more information people have access to, the more they can sort of put themselves in the rooms or the conversation where these deals happen. So I'm hoping that this checklist helps early stage founders arm themselves with information so that they can make the right decisions to get the funding that they need.
Thanks, Titi. So here I have a slide of the venture capital process. So that's a shot that is taken from the document that you have written. Can you please tell us a bit more? Can you walk us through your findings on the overall DD process?
Yeah, sure. So there's 6 main stages in the process. There's the culture fit stage, the initial screening stage, the LOI, the business due diligence, the term sheet, and the legal and transactional due diligence stage. So the cultural fit stage is pretty brief. It's all about whether or not this company fits into the VC's portfolio. So fit can mean region or industry or fundraising route. So VCs can gauge this just from the data points, whether the startups is actually a good fit. So it's not an indication on the future success of the startup. So for example, if I'm a VC that invests in West African startups and your startup is based in Morocco, we probably won't move forward with the conversation. Sometimes it's just that simple. The second stage is the initial screening, and it can also be considered due diligence light. Here is where we look into the pitch deck and get a feel of who the founders are, what the business plan is, and what the financials are. And after this stage, an LOI is usually presented to the founder, which is basically a non-binding NDA that spells out the terms of the potential investment. So next up is the business due diligence stage, which is pretty intense. This is where we get into the KYCs, audited financials. You may get questions on the hiring process. VCs may want to know about the sales and marketing plans and so forth. But once you get past this level, we move into the term sheet. So as you mentioned earlier, we had a similar presentation on the term sheet. So we have more information on this on the Digital Collective Africa site, but this is also where the exclusivity clause comes into play. And then last, there's the legal and transactional due diligence, and this is where we look into documents relating to intellectual property or contracts with suppliers, for example.
Okay, thanks, Titi. And I guess in the document, you will have, at each step, you will have the kind of documents that are required, right?
Yes.
Okay, interesting. So now here on this chart, so you're going to take us, in the document, you're taking us through the different stages, and actually the different stages where the founders ran into trouble, if I may say, or at least don't go further with the investors. So can you just quickly, can you tell us what are the most common stages where these founders get into trouble?
Yeah. So what I've learned is that founders run into stage during the very early conversations with the VCs. So to save both parties time, it's important that founders reach out to VCs that fit. So if you're an AI startup based in Nigeria, look into VCs that sort of match your region and your industry. This information can be found on the website, or you can look through the VC's portfolio just to get an idea of the type of companies and where they invest. The second place founders run into trouble is the LOI phase. So this is a key place where deals sometimes fall apart. Since the LOI phase states the terms of the investment, this is a spot where there could be a potential mismatch between expectations regarding valuation and control. And then lastly, I would say the legal due diligence part is also a problem area. This is usually where a lot of holes are found, some of which are deal breakers and others that can be sort of mended as milestones in the shareholders agreement.
Interesting. I would be interested to see the feedback from our panelists on this graph and the previous one. Very interesting, Titi. On this slide, so now you're taking the founder side, and that's an interesting slide where I think also our panelists are going to have a lot to talk about. Can you tell us a bit more about how could the founders actually take more ownership in the DD process?
Yeah, for sure. I think the most important thing a founder can do is ask a lot of questions during the different phases or stages of the process. I think people compare the founder VC relationship to a marriage. So not only are they trying to get to know you, but you're also trying to get to know them. So you can reach out to portfolio companies to sort of gauge their relationship with the VC, like what has worked for them, what hasn't worked for them. You can find out how else they can support you in addition to providing capital. You can ask them questions about their risk tolerance or how to help you close the gap in the missing items that they found during the due diligence process. Founders should make sure that they're going into this relationship with a clear understanding of the VC that they'll be working with. Also, I would say in regards to like data protection, your data room, logistically speaking, should make sure that your data room matches a checklist. So it's easy for you and the VC to navigate. Also, like share a link, whether it's a Google Drive link or Dropbox links or whatever you use to like keep track of your data versus sending emails. That way it's easy for you to control like how your data gets shared or who shares your data. And lastly, I would say just don't feel overwhelmed by the process. You don't have to have your data room 100% complete before you start, but you need to be honest with the VC on what you do and do not have. If you don't have something, don't quickly like create it just to say you have it. So I feel like honesty is also a big part of this relationship.
Yeah, and we'll touch base on that during the discussion, but obviously you don't need you don't need the same documents when you are raising 100K or when you are raising 5 million. So it's all going to depend on the stage of the company. I know that in your document, it is quite an exhaustive list. We'll discuss that just after your presentation, but indeed, for the sake of time, and you don't need all the informations depending on the stage. Regarding this information, actually, could you, in a nutshell, summarize the key information that VCs may request? Obviously, keeping in mind that the level of information is not going to be the same, again, if you raise 5 million, 10 million, or 200K. The whole idea, again, of your document is to be able to, this document is for early stage startups raising pre-seed, seed, but also for Series A.
Yeah, definitely. As you mentioned, it's a comprehensive document just to make sure that everything that you could possibly be asked is in there. That doesn't mean you will be asked for all those specific items. So the first part would be the initial screening. So this is usually like your pitch deck. So you'll have stuff in there like your business model, recent press, your MVP, what the addressable market is, and so forth. The second bucket of information will be asked for will be in your business due diligence. So this sort of goes into the weeds, as an extension of the initial screening. So it's a deeper dive into information like regarding your team, like credit checks, criminal records, etc. You may be asked about non-competes, details on business processes for things such as recruiting and training employees, and expect details on like financial controls and taxes. The last bucket is legal and transactional due diligence, and this dives deep into any dispute or agreement relating to intellectual property, as well as contracts or information on who the shareholders are and who the board of directors are. And additionally, depending on the kind of business, you may be asked about things such as like your annual recurring revenue if you're a SaaS business, or manufacturing strategy or quality plan if you're like a hardware business.
Okay, thanks, Titi. Thanks, Titi, for this walkthrough. Well, obviously, it stays very high level. Again, I invite everyone in the audience to just have a look at the document to get more detail. Without further ado, I'm going to jump into our panel discussion. So today we have 4 amazing panelists. Let me name them, starting with Dhanyal Davidson. Dhanyal is currently the CVO, Chief Valuation Officer at Goodwell Investments. Dhanyal is a former senior auditor and consultant on anti-money laundering and M&A at Deloitte. Dhanyal will be joined by Philippe Kiracofe, CEO and co-founder of Startupbootcamp AfriTech. Among others, Philippe is also co-founder and partner of Horizon Ventures, an early-stage investment company. He will be joined by Femi Adeyemo, founder and CEO of Arnergy, that I'm sure you have heard about. Femi, with his company, raised his Series A last June, if I'm not mistaken, of $9 million. Our fourth panelist for today would be SG Laubscher, director at Dommisse Attorneys. SG is a lawyer specialized in VC, PE, and M&A. Thank you very much to the 4 of you for joining us today. So lots of things to touch base regarding Titi's presentation. I would like to start with Philippe. Philippe, we have been talking also about the importance of the first meeting when it comes to founders and investors, and understand the mutual expectations on the founder side, but also the investor side. Leveraging on your experience and the work that you are doing at Startupbootcamp AfriTech, can you tell us more about the importance of understanding how much is required and expected from the entrepreneur, depending on the company stage?
Sure, and thanks for the opportunity, and thanks for all the amazing work, especially with TT putting together this document, or leading the effort to put together this document. It's absolutely essential, and part of the reason is that by standardizing these types of checklist, it really gives both sides, the investors and the founders, a good roadmap as to what they're doing. The work that was done by Dommisse in putting together some of those Series Seed documents that have now become really the standard investment documents have helped improve the process. So we really think that this is going to improve the process as well. So one of the most important parts is by giving examples for the founders in what to expect. So most investors going into these meetings, investors are looking at dozens or hundreds of deals. So they have a good idea of what they're looking for, and they have a good idea of what the process is. But for most startups and the founders, this is the first time they're going through this. And even if they've already completed one phase of, friends and family fundraising, the next time they go out for angel funding or their first institutional round, it's a brand new ballgame. So the problem is that founders then grasp at straws. And if they have a really good meeting and someone seems to really like their app or their product, or just like them, then they will continue chasing that investor for a long time, really on the hopes that having a big pipeline of prospective investors somehow gives you greater probability of success. Whereas in fact, we try to advise all of our startups that the most valuable thing is your own time. And your goal as a founder is to eliminate investors as fast as possible, so that you're not wasting time on investors where there's an obvious mismatch. So, the example that was given before is a geographic, if investors are only looking at South African investments, and you're a Nigerian startup, then there's no point in having a further conversation. If there's a stage mismatch, or if there's another deal breaker, like that investor is looking to put $10,000 into your deal and expects a board seat, and you're not looking to give a board seat for someone that puts in less than $200,000, then that's going to be a non-starter. So the faster that you can get those key things out of the way, the faster you can eliminate investors that have a very, very low probability. And that's why when you saw the chart, we've advised to kind of give you as a founder an idea that the vast majority of initial meetings with investors are going to end up with them not proceeding. And you're trying to, you shouldn't consider that a failure, but rather you've just saved yourself a whole lot of time. So the purpose here is to give the founders, to empower the founders so that and you feel confident asking some of those key questions for yourself right up front, and that what's reasonable for investors to ask for you in those early stages. As was mentioned before, the checklist is going to be broken into multiple stages. So at the very early days, nobody should be asking you for deep technical information or for management accounts of your company. That should only come much later. And if it is asked for you at that stage, as a founder, you should feel confident saying, look, when we get to that point, I'm happy to share. Right now, we're trying to get high-level terms. So that's really the high-level objective of the document, is to empower the founders. And hopefully to end up saving both sides a lot of time, so that more transactions can get through the pipeline. Thanks.
Thanks, Philippe. Yeah, if I got it correctly, the importance, and from the founder's perspective, is to ask the good questions, basically. In order to detect any deal breaker before wasting anyone's time.
Absolutely, yes, and also to know. To feel empowered to push back if questions are being asked of you that are kind of premature in the deal cycle.
Thanks, Philip. Femi, I'm going to you now. So for the ones that have joined us recently, Femi, CEO of Arnergy, you've been raising $9 million for your Series A in June 2019, last year. For the entrepreneurs in the audience, what are your key takeaways after you went through that whole DD process? Femi, can you hear me? Maybe you're on mute.
Yes, I can hear you. Can you hear me now?
Yeah, that's perfect.
All right. Yes. Thank you, Leo. And I align and agree with everything that Philip said, in the sense that you have to ask the right questions as early as possible. And I will add to that by saying that as entrepreneurs, you need to even be able to profile the investors, because not all investors has the mandate that align with your business as an entrepreneur. So I think that's important, because if, for instance, the investor's mandate does not align with what you're doing, you're just going to be wasting time. So it's better to ask all of those questions that Philip had mentioned at the early stage. Of course, based on our experience, I can tell you that we had a list of investors that we profiled that, in our space of clean energy, impact. We knew that even within that space, we knew that there were some investors that what the focus is in the value chain does not align with what we want to do. So if we had, and I can tell you prior to even when we raised the Series A, there were a few of such investors. And of course, because we were just learning then, right? So we probably spent some time that now we would not have spent if we're starting again. So it's very critical that at the initial stage, it's clear what the goals are. But largely, based on our experience, raising Series A, I can tell you that due diligence is very critical. I don't know if you want me to go deep dive now, or you want to go
just high level key takeaways.
High level. Okay, so fantastic presentation from Titilayo. Of course, initial due diligence is very critical. She mentioned business, legal, and financial. That can't be overstated, really. Those are very, very critical. I'm not sure if she mentioned financial, so I wanted to speak on financial, because financial due diligence is very critical to a very large number of investors. For instance, you want to be sure I'm sure almost all jurisdictions has tax obligations, right? Investors want to be sure that they're not investing in a company and maybe thereafter, after the investment is announced, you can't do business because over several years prior to the investment, you've not been compliant based on even some of the financial obligations or corporate statutory that are required for organization. So, so I think on high level, I can leave it at that for now. Legal, very critical. And I think even partnership, right? For instance, based on audited accounts are very critical, especially if it is early, if it's a Series A, investors want to know that you are up to date with your books. And of course, there are some conversations around if the investors really like you. What I've realized is you might not, as an entrepreneur, have everything. So there can be conversations around what becomes condition precedents in the due diligence and what investors might be comfortable with to move with what it's called condition subsequent, because that means the deal can actually happen, but maybe financial close won't happen until some of the items on that checklist are completed. So those are some of high level, but I'm willing to take more questions to dive deeper.
Okay, thanks, Femi. So if I can sum up your contribution, do your DD on your investor. Okay. And if I got it correctly, get a quality data room with all the documents that are required to the stage of your company. Which takes me to you, Daniel. So more than the CVO at Goodwell Investments, you are also a senior investment associate. Can you, related to what Femi just mentioned, can you tell us how does a wide populated data room fit into the investment decision actually?
Sure. So, for us, often when looking at somebody's data room, many startups don't realize that you are also, as an investor, taking some data points out of this. If, it's extremely organized and the data you are looking for is there, it's sort of another positive sign for an investor. And the other thing a lot of people forget is that, on the other side of this investment decision is an investment analyst sitting in his office, tired, or actually sitting at home these days, tired, just wanting to get the job done. And if you help the analyst get that job done, that's how you can often win favor with an investor. Get them to like you, make their job easy, and help them get the deal over the line. And the data room is a key part of that. Give them the information they need, make it easy for them to find it. And if it's not there, be able to be in a position where you can get that information to them as quick as possible. I would say it's extremely important and such a big part of the investment decision.
Thanks, Daniel. Staying with you, Daniel. So you're more working on the financial side. Can you tell us, to the entrepreneurs in the audience, can you tell us which documents are actually, which documents will be looked with a particular interest from the investor side?
Sure. So I just want to separate the sort of investor looking at the financials and what Femi referred to earlier being a financial DD. So from the investor perspective, we're a lot more focused on historical financials and then also forecasts. So what are your projections? What does the business look like in 5 years' time? Where are we going? And what's this journey we are going to be a part of? And the other sort of bigger portion of financial due diligence, we actually outsource that to people who are actually experts in the space. So they'll do a much deeper dive. They'll look into your specific accounts. They'll check your bank statements. They'll see if you've been paying your tax, paying your employees, read some of your agreements, and they'll then provide a report to the investor. So similar to what SG will talk a little bit about in relation to legal, we have guys who do that for financials as well.
Thanks, Daniel. Yeah, talking about the experts, let's indeed move to SG. SG, thanks for being with us today. Still on this really DD and data room section. So the difference between the DD room, so the paperwork, and the real business. So what happens in the DD room validates, or should validate the business. And from a legal side, can you tell us a bit more what are the main items that are the most important when doing a legal DD?
Yeah, thank you again for having me as well. And I would just like to echo what Philip said about the essence of standardizing these processes cannot be understated, because I can tell you that a lot of the discussions that startups and investors have with us on a day-to-day basis is around questions such as, what is normal? Is this normal, this thing that's being asked in this case? And so a lot of our effort and advisory capacity goes into advising on whether something's normal or not. So if we can standardize these items, you get a lot more value out of your advisors. So I would actually recommend that something like this due diligence checklist helps an investee company to build their company in the correct way right from the start. So I always, it's not like that I cringe, but I know trouble's on the way when we talk about the legal documents as paperwork, because then I know it's somewhere in the dusty, in the dusty parts of your business, all your legal documents, and you see the real business as something separate. And I think about my very first DD that I ever did I was very excited. It was a company in Botswana. I was flown to Botswana at the time, and I was very excited. I got to the company and I asked them to share their data room with me. And they took me to it literally looked like a broom cupboard, and there were documents, physical documents all over the place. Now, I know that we'll all laugh at that right now, but I think even in a digitized space, our data rooms can often still be the broom cupboard of our organization, and you see the real business happening somewhere else. But I think you need to think about your data room is the boardroom of your business. It showcases your value. It showcases the journey, all the sweat and effort that goes into developing your business. The investor walks into that room, and if it looks like a broom cupboard, immediately the validation of your value goes out the window. So this is not a question of trying to overstate the importance of legal structures and things like that, but it's I think it's just very important to validate your values. And so I always talk about the 4 pillars that need to be in place, for a sound company, even an early stage one. The first one is your structure around your shareholding and governance of the company. So make sure that there's clarity from your existing shareholders and directors know exactly what the governance structure is, that your governance structure is in line with what the status of your company, the phase in the company's life cycle. Your governance structure should support that. It shouldn't be something that frustrates your operations. It should be something that sustains and supports that. The second thing is whether your company is business ready. Does it have all the operational agreements that it needs to conduct business? If you have revenue forecasts and things that you're presenting to the investor, I'll be looking at whether that's actually realistic, to look at how many contracts do you have with your customers, how sustainable is that revenue, how easily can the contracts be cancelled, things like that. Obviously, it's also very important, even in an early stage, for an investee company to show that you know exactly what is the regulatory framework within which your company operates its business. That doesn't mean you need to have 0 legal risks and know exactly, like, to have everything, all the risks, gone with 50-page legal opinions, but you need to know exactly what are the risk elements of your business from a regulatory perspective. If you can at least tell an investor what are your plans, what is the journey that your company intends to go through to make sure that it's fully compliant with legislation, and you need to at least demonstrate that you know what that journey is. Then a very critical one for tech companies especially is to show that you understand the key assets of your company. So as I said, you need to build this company and your data room and all of this with the end in sight. So you need to ask yourself, if I sell this company today, what are my main assets? Are those assets protected? Am I using the best ways possible to commercialize those assets? In other ways to generate revenue from those assets? And am I making sure that someone else can't just replicate what I'm doing? And that's a conversation that often happens, and those are so you need to identify your key assets and show how you are protecting them and commercializing them. And then lastly, and we always phrase this as a separate pillar just because it's so important, but employee relations. So in a startup company, your employees are basically the company. So if there's a very key employees in the company and you can see that they are earning below market related salaries, which is often the case for early stage companies, you need to show that there's other ways that these employees are incentivized to remain in the business and to grow the value. If there isn't a culture of incentivizing and protecting employee interests, then it's not really a company that from a legal perspective looks very sound, because these employees can just leave any day, and employees walk away with so much know-how, and there are ways to protect against that, but it's also obviously important to know that from a positive perspective, there's enough incentive built in for employees. then I think something that is you'll find increasingly important, especially in the last few months, a lot of talk about ESG, the environmental, social, and governance culture of the company and its processes and policies. So I think someone like Dhanyal will be able to elaborate on that at some point, but it's critically important to show that your company has a healthy footprint on the environment, that its social impact is sound, and that its governance prevents and corrupt activities and stuff like that. So I think we'll see an increasing focus on that as well. So from my perspective, in a nutshell, those are the sort of most important things.
Thanks, SG, for this detailed contribution. Definitely interesting. Philip, I have a question for you, a bit more practical. You are a pre-seed, a seed startup. It's fine. You put your data in a Google Drive, in a Dropbox. It can still do the trick. But as soon as you're going to start and you're going to scale a bit and raise your Series A, your Series B, can you tell us a bit more about what would be the most appropriated tool depending of the stage of the company? So pre-seed, seed, we are raising between 100K and 800K, and then Series A, Africa, so we are raising like 2 millions up to 4 millions.
Yeah, so we always advise use the simplest tool that gets the job done for as long as you possibly can. So if you can use Google Drive and Dropbox, as most of our startups do in the Startup Bootcamp program, you can use that for as long as you possibly can. Then you're winning. And I would certainly offer. Well, let me just answer the rest of that question, I guess, on the tool real quick. I mean, there is a point in time, possibly at your Series A, but certainly beyond that, where you would upgrade to a tool like an Ansarada, which is incredibly robust and is an exceptional tool, but it also does require quite a bit of work to get it set up. And so you just don't want to be investing the time and effort on such a robust tool until the numbers, the fundraising round sizes are big enough to really justify that. By that point, if you're at the Series A stage, you've probably got people on your team who can actually spend the time to set that up right and manage it and monitor it. And when you do, of course, it's very robust. There's extraordinary data that you can capture or that you can see about investors, what they're looking at in your data room, how much time they're spending on specific documents. There's really phenomenal protection. But again, most of that you don't need until you get to those stage. And truthfully, if you are just asking the right kind of questions to the investor in the early stages of the conversation, you'll really bypass the need for most of that. So, as SG was highlighting, if somebody's asking about, what does your ESOP plan look like, or, tell us, give us detailed information about your ESG policies, those conversations should really be happening much, much later in a process. 80 or 90% of your investor conversations won't ever get to those stages. So if you're at a first coffee meeting and someone starts to delve into those kind of questions, we would typically say that that's a warning sign. Unless it's something specific to a mandate, then they're probably focusing on the wrong types of aspects. So a very simple data room. If you're using a Google Drive, you would basically have, say, you would have one version of your Google Drive that's for that initial screening. You'd have a slightly more robust version of a drive with some additional folders for once you get into the later stages of due diligence. And then, of course, once you get to the final stages of due diligence, legal and your management accounts and those things, then you would open up the kind of the third tier. So, you can use it in stages like that, but that will certainly save you a lot of time and effort in the setup and the maintenance of it, while still achieving, the result that the vast majority of investors, will be happy to just see fairly rudimentary tools.
Yeah, so the importance of having a well-structured data room on an appropriated tool depending on the stage of the company with, if possible, different tiers that you will open up depending on how the discussion is going.
Yeah, and just to highlight that, I mean, so when the investors ask you for your data room, you know, if you're switched on and you say, look, I'm sending you the initial screening, you know, we have a much more robust data room that we'll share if we get to the next stage. That's a way of signaling to the investor, and Danielle was mentioning this before, you're signaling to the investor that you know that there's more important things that are at a later stage, but that are not relevant now. But it prevents the investor from looking at your data room and suddenly saying, oh, well, these guys, you know, this is a very empty data room. You're signaling up front, no, there's a lot more to this, but I'm revealing this at the appropriate stage. That lets the investor know that you have a good idea of what the process should look like.
Yeah, okay. Thanks, Philip. Femi, I'm going back to you now. So when you've been undertaking your DD process last year, can you share with us, do you have any advice to the entrepreneurs, the founders in the audience? Any specific pitfalls that you may have encountered? I don't know, a document that maybe took 2 months to arrive and you were thinking it was going to take 2 weeks. Do you have any advice to the entrepreneurs on how to prepare the DD, or some pitfalls that you have encountered and you think that can be avoided?
Absolutely. I think a few of that on financial due diligence, right? So we had some death prior to our Series A. And of course, at the early stage, for most investors, maybe at that point, we were not able to afford a current legal advisor. So there were some lines that we probably were not paying attention to, or it was I think in our case, it was a take it or leave it deal. And at that point, 4 years ago, we needed the money, right? So then it became a point that we needed more or less a no objection letter from the death investor, you know, and that took some time, you know. So I think entrepreneurs has to always try to see into the future, and before you sign anything, even some of those take or leave deal, you have to plan ahead. I think in our case, if we had probably started conversation with this debt provider earlier than when we started, we probably would have gotten that document, which was the no objection that allow us to be able to bring in the equity investor. That's one. I think the other bit, again, is on the financial due diligence. Like, I think it was Dhanyal that mentioned that they will always get experts to carry out the financial due diligence. So in our case, we had one of our investors bringing on board a Big Four audit firm, you know, for the financial due diligence. And you know what that means? It was really, really thorough, you know. So I think investors will entrepreneurs will do themselves a lot of good by following a lot of what Philip said on the deal room, you know. Have your deal room ready, and on, if it's not a weekly basis, at least on a monthly basis, ensure that you have your financial folder, your legal folder, all of those folders ready. You know, tax is, I mean, in this part of the world, for instance, in Nigeria now, small businesses, not everyone takes tax clearance very, very important, but it's very critical because no investor is going to invest if you don't have your historical tax clearance certificates in place. And in this part of the world, that might take some time if you don't have it prior to you getting to due diligence stage. I think those two are very critical. But I need to say that on the conversation around ESG, or a few of those requirements that are critical, but for instance, ESG, there was, I think, one investor that we had to we had to let them go, you know, because we look at the requirements on ESG, and I mean, we look at it and said, you can't expect us pre-Series A to have been able to tick all these boxes, because that would have been very expensive. You know, prior to Series A, we didn't have a resident ESG manager. Even though based on corporate governance, as much as possible, we were following. I mean, we had audited accounts from the second year of incorporation. You know, so, I mean, for those that are critical, we were, but ESG, we couldn't have had ESG manager 4 or 5 years ago. But we had an investor that even wrote us, I mean, they gave us a term sheet, but we were going to pay for ESG due diligence. And they were not going to pay for that, we were going to pay. I said, no, that's not going to happen. And we walk away from that deal. And I can tell you that would have been at least a third of the $9 million that we raised. But we knew that that's a red flag, you know. Mm-hmm. And I can tell you that at the end of the day, when we then raised at $9 million, the top investors that are very, very, very ESG compliant, and I'm talking of some of our DFI investors, we were able to sit down and we then had a roadmap, which points me back to what is called the condition subsequent. So we then had to say, okay, your ESG is not up to where it's supposed to be based on IFC framework. You have 6 months or 9 months to be, I mean, after the investment, you need to put that together, and we then agree that that's a condition subsequent. So again, entrepreneur needs to know some of those red flags. If investors are killing you for things that are not, I mean, I won't say ESG is not critical, but pre-seed or pre-series A, there's some of those things that, I mean, I don't expect investors to expect that if you start a company today, in the next 12 months, without any investment, and you're having ESG manager, chief sustainability officer, and all of that, those should even be red flags to profitability.
Thanks, Femi. Takes me to Daniel. Daniel, we have 3 to 4 more minutes before we start the questions and answer, even though I can see that Philip is quite active on chat. But Daniel, Femi, as mentioned, without pain, the financial DD. So can you tell us more about the financial DD, and can you share with us what are the main deal breakers that you have seen when undertaking financial DD?
So I'm going to speak more specifically on the side of the investor and less on the side of the expert doing the financial DD. I would say that some of the, you know, when looking at the projections, your investment analyst is going in and having a look at what are the assumptions actually underlying this business and the journey it's going to go on. And if there seems to be a really big departure in your understanding of the business and the assumptions that are being put forward, and they just seem, you know, grossly optimistic by the part of the founder or the startup, that might be a little bit of a concern, because, you know, your perception of the journey the startup is going to go on and its growth path is different to what the founders think. And you don't know where those assumptions are impacting the business outside of just financial projections. So I think often you see founders being over optimistic, but I think it's when it's really sort of way out of the ballpark. That's when you start being a little bit concerned. The second thing is if you see that the projections are sort of really rudimentary. So the guys don't really, you know, a team might not have a proper skill set in the space of finances yet. And the problem comes in is if they are not aware of the fact that they don't have that skill set. I think if guys are upfront and clear about it, that listen, you know, we struggle setting up our financial projections, especially at the seed and pre-series A stage. people are happy, even as an investor, to step in and help you. I mean, I've seen Philip many times help people with their financial projections, sitting down, like actually working through it with them, you know. So it's, again, coming back to honesty. It's about knowing what you as a startup have and don't have. And if you coming in, you know, establishing yourself as perfect in the financial area and confident in your projections, and the investor sees it, and you sitting there thinking like, whoa, you know, it seems like this team doesn't know what they're doing here, then I think that's where a problem might come in. So those two are sort of two red flags that I would consider.
Thanks, Daniel. Just very quickly, we are going to jump into the questions. This webinar will finish in about 10 minutes that I will keep for some questions and answers. But that quickly, SG, I would like to get your input. A bit same question as Daniel related to, but now related to the legal side. In a nutshell, the deal breakers that you see usually.
So I would say, someone touched on it earlier, but if you've got, if you have agreements with existing debt founders, for instance, that where the liquidity of the company is under pressure because it needs to repay those loans, unless there are plans, realistic plans to repay those loans in the immediate future, if the terms of those loan agreements give the lenders quite a strong position to, for instance, if it's a secured loan over your assets and you've basically given some of your assets as security, and there isn't a realistic chance of having those loans repaid in the immediate future, then that's a massive risk because your assets are exposed from a legal perspective. And then the biggest deal breakers I've actually seen in recent years are things like structure. So if you have companies that span over different countries where you've got ownership, you know, in different countries and companies operating across different jurisdictions, and those structures are not compliant, the company is under the risk of actually, you know, diluting a big portion of the investment value to fix those structuring issues, or to possibly even incur, you know, penalties from authorities and stuff. And I'm not talking about just normal structures. I'm talking about people that set up. We often see people setting up a company in Malta, but it's 4 guys in Cape Town running a business, but they somehow think they are now tax resident in Malta just because they have a company there. And that's the kind of stuff that I think you need to be able to answer the basic questions about your legal structure to an investor, because otherwise that investor will be confident that if you don't understand your structure, then there's some risk, massive risk there, because your business operations might not be in line with what your legal structure looks like. So those are the sort of high level key items, I would say. Probably the first one being the more prevalent one.
Thanks, SG. We have 7 minutes left. I can see there's a question from Ropa in the chat. Just before answering that question, Femi, I have a question for you. How much does it cost to go through a DD process, and who is paying for it?
Okay. Very good question. So I think, like I mentioned, so we had different investors. We had a syndicate, but before they came together to become a syndicate, we had some of the prospective investors that we have to walk away from. So I think that as much as possible, investors need to pick some of those bills. Legal fee, I've seen that legal fees most times that will be passed to the company. However, for investors that are really keen on doing business, they are happy to let that be done post the investment. But I've seen instances, I've seen some investors that will even want that to be paid by the company pre the investment, and that's a red flag. You know. So as much as possible. For instance, I can tell you that a financial due diligence are investors that requested for that foot the bill. But on the legal advisory and all of that from the investor side, we had to take care of that.
Okay. And in terms of cost, I assume it depends of how much data has to be treated and how much documents have to be validated.
Yeah, absolutely. But one advice that I will give from where I'm sitting is, again, I think it's good to have that conversation even with the investors from the onset, and it probably might be a good idea. SG might have something to say to this, but I will say that it probably might be a good idea if the company will foot that bill. I am of the opinion that the entrepreneur should have some say in whatever the bill is going to be at the end of the day. Otherwise, legal fees could go over the roof, you know.
Okay, thanks, Femi. We have 4 minutes left. Actually, we have a bunch of other questions in the chat. Let's try to answer the most of them. Philippe, I know also that you need to leave directly at 4 p.m. So a question for you, the question from Ropa actually, it is related to your contribution related to sake of time for founders and investors. The question, what are the key questions a startup should be asking investors in order to save both parties time? If you can just give us a quick answer on this.
Yeah, sure. So actually, that's a big part of the document that's been put together on the TT. So there's a series of questions at each stage. So it's really important to understand not just what are the key questions, but what are the key questions per stage. So, you know, as Femi just mentioned, you know, understanding, you know, who's expecting to pick up the legal DD, you know, is not a question you necessarily need to ask at the, you know, at the first coffee meeting. But, you know, are you expecting a board seat is absolutely a question you want to understand. Because if you're, you know, again, you know, I mentioned this example earlier, but, you know, if you're only offering up one board seat to whoever the lead investor in that round is, and here's somebody that's coming in for 5% of the round or 10% of the round, I'm thinking they're going to get a board seat. And that's, you know, and it's clear that that's a critical step for them, then, you know, you're not going to want to spend more time on that. Like you're not going to get them off of that pillar. And before they've even gotten excited about the company, you already know it's not worth. So, you know, pay for the coffee, walk away, and you've saved yourself a lot of effort. So all of those types of questions are going to be critical, but, you know, there's probably 4 or 5 that you want to know right up front. What kind of investment vehicle instrument are you comfortable with? So if we're raising money on a safe or a convertible note and you only want equity, boom, meeting done, right? Board seat we mentioned, you know, ESG, you know, those kinds of things. Also, you know, mandate stage, you know, are you looking for a, you know, are you only investing on BEE? Because we may or may not meet that requirement. Especially even if it's a South African company, but you've incorporated offshore, or you plan to incorporate offshore as a holding company, that could be a deal killer. So those are the kinds of things that you want to be able to knock out. I saw a comment in the window about, you know, if 95% of the deals fall apart, why are investors doing DD? This is part of the DD, so it shouldn't be a formal DD process. It really should just be. Your goal is to get those 95% out of the way as fast as you can, so that you can really commit your time to the 5% that have a real possibility. Yeah.
Thank you very much, Philippe. We are arriving at the end of our webinar. I just would like to ask one more question to our panelists. Philippe, I know that you need to leave, so thank you very much for your participation. Philippe, just last question to our lawyer. About privacy. Agreements often contain confidentiality provisions. Furthermore, privacy laws may limit providing requested DD checklist information. The question, how work through the issues of confidentiality and data protection. SG, if you can give us an answer in 1 or 2 minutes.
Sure. I think the issue comes down to if you have information that investors asking for that you have under confidentiality with someone else, with another entity, for example, then you could obviously just get permission from that other entity that controls the information that you can share. So that's the simple way to get around that. You would get permission to share that information in a controlled manner. Regarding data protection, that is a bit more tricky one. If you know that you are going to be breaching data protection laws, if you share certain information with investors, then you'll simply need to be able to cite that, tell the investor exactly what those restrictions are that you are bound to and why you can't share the information, and then try to share the information in a way that doesn't breach those data protection restrictions on you. But I think make sure that you understand exactly what the restriction entails before you tell the investor you can't share something, because it can obviously create unnecessary angst from an investor if you say, no, you can't share something, there is confidentiality, but you don't have specific reasons why, or like concrete reasons why you are prohibited. So I think just have sort of clear answers ready for that, I think. And then you can try and find a workaround with the investor.
Thank you very much, SG. So it's 4 p.m. here in Cape Town. It is the end of our webinar. Big thank you to our 4 panelists, Philippe, SG, Dhanyal, Femi. Thank you very much to the 4 of you. Obviously, big thank you to Titi for the work that she has done to put common due diligence checklist on place. The document is available on the collective website. Thank you to you in the audience. Thanks for joining us today. It was a very insightful chat. I hope that we will have the opportunity to have such discussion in the future. I've shared my email address and LinkedIn in the chat, so let's keep the conversation going. I can also maybe be in touch with the panelists and ask further information if there's really burning questions. And yeah, that's the end. Have a nice afternoon, and we will see each other maybe on another online meeting, or hopefully in 6 months or a year in an in-person event. Otherwise, yeah, let's catch up on LinkedIn and our other virtual events. Bye, guys, and thanks to everyone. Cheers.
Thanks, guys.
Thank you. Cheers.